Thanks for joining, everyone. As you can see from our headline today, we have some positive news to share. Continued impacts of the pandemic in our first quarter were followed by a solid recovery in the second, with momentum building. But before we get into that, I'd like to start today by thanking all of my colleagues for their resilience throughout this pandemic. Our three core values at Kin Carta are courage, compassion, and connection. And our kin have demonstrated all of these qualities in ways that I couldn't have imagined. Thanks to their hard work, momentum in our business is building rapidly. First, let's take a look at the numbers. Net revenue from continuing operations was £64.1 million, down 10% compared to the last year when including acquisitions. Continued impacts of the pandemic in the first quarter were followed by a solid recovery and growth in the second, and this was as expected, as it takes time for our digital transformation programs to ramp up. Backlog is a term you'll use or you'll hear a lot today. And backlog is how we measure signed and committed work from our clients. And I'm happy to report that we had record backlog at the start of our second half. More on that in a moment. Our adjusted PBT was £2.9 million, which does not include another £3.6 million of US government PPP loan forgiveness that we're now expecting in the second half. Total profit before tax from continuing operations was zero, compared to a loss of £5.9 million a year prior. Net debt is sitting at £22.5 million, which is down from £39.5 million in January of 2020. And that gives us an adjusted EBITDA ratio of 1.6 times. And as a reminder, we divested non-core ventures businesses Hive and Pragma for £12.6 million. This is a slide as a quick reminder of who we are. Kin Carta is a responsible and growing global digital technology services company that delivers outcome-based transformation for the Global 2000. We're structured as a platform-based organization that enables the borderless connection of three valuable schools of specialist talent. Kin Carta Advise is our digitally native management consultancy, which serves our CEO clients. Kin Carta Create is our modern cloud data and software engineering studio, which serves our CIO clients. And Kin Carta Connect is our data-driven marketing technology agency, which serves our CMO clients and their specific transformation agendas. We're headquartered in London and Chicago, and Kin Carta nurtures roughly 1,500 engineers, strategists, and designers with a maker culture that serves the healthcare, financial services, B2B, consumer, and transportation sectors. This is a list of our core propositions, or what we do for our customers. We help companies create new digitally driven business models, new products and services for them to bring to market. We help companies respond to the Amazon threat by building their own market-leading e-commerce experiences and customer journeys. We help companies rewrite decades worth of bespoke legacy software and move it to the cloud, enabling innovation and agility for those organizations. We help companies implement and utilize advanced data science platforms to help them make better decisions. And we manage and operate all of these things that we build for our customers with our digital operations managed service. And we work with some of the largest enterprises in the world on these initiatives. Now, in terms of operational highlights from this first half, if you're going to walk away with anything, I'd like you to remember these 3 points. Our pandemic recovery is leading to sustainable momentum. The launch of Kin Carta Data Labs, which just happened last week, and Kin Carta as a talent destination. I'd like to talk to you a little bit about the supply side of our business. So first, on the recovery and momentum, we expected recovery from a lot of our clients that had temporarily frozen budgets in the late spring, early summer months, kind of the heart of the pandemic. But this has subsequently led to strong demand as the period progressed and digital transformation made its way to the top of most boardroom agendas. I mentioned at prelims that we were staring at the largest pipeline in 12 months at the beginning of our first half. And our sales teams have delivered on the promise, and we now have a record backlog of work. Our key management internally that we use or one of the key metrics is what we call our 90-day net revenue backlog. So that's the amount of backlog that we have secured for the next 90 days. And that number is 77% higher in February than it was in August of 2020. And it's 27% higher than in February of 2020, so before the pandemic began. So that's a great place for us to be. And throughout this first half, we have secured some very exciting new clients. For one, we're driving SecureWorks, which is a Dell subsidiary, their transformation from a managed services cybersecurity company to a completely digital self-service SaaS company through digital product delivery. For Fifth Third Bank, we're accelerating their digital transformation on both the commercial and consumer fronts through cloud modernization initiatives. Our transportation sector has been hit pretty hard during COVID, but our team managed a strategic win with Blue Origin, which is Jeff Bezos's SpaceX competitor. So our first journey into space. We have been selected to build a data management and operations platform for NASA's Artemis program. And Artemis is the program, Artemis's goal is to land the first woman on the moon in 2024. So we're very proud to be a part of that. We also secured the new client Syngenta, which is a $25 billion seed manufacturer. And that was inspired by all the great work that we've done for Corteva over the last few years. And they've engaged us to revitalize their digital experience. And finally, The Economists, we're redesigning and replatforming their flagship mobile product. So some very meaningful and exciting new customers in addition to expanding agendas at our blue chip existing customer base. And finally, the chart at the bottom of the slide here shows our pipeline value over the last 12 months. So I mentioned, you may have remembered in August, at the beginning of our fiscal year, we were very excited about the size of our pipeline and the fact that it was at 12 months highs. And that, of course, has led to our record backlog. But as you can see here, our pipeline has also considerably grown since even August. And that's with a significant portion of that converting to backlog. So in other words, we're expecting momentum to continue to build from here. Next, we snuck in a couple transactions before the holidays in case you missed it. We sold our healthcare communications business Hive, and we bought a fantastic data science company headquartered in Portland called Cascade Data Labs. And our new data transformation offering within our Create pillar, it's really been accelerating. And this was evidenced by, I touched on this in our prelims at the beginning of the year with our Pepsi win. And that is now contracted with an 8-figure annual spend as we had projected. But to more specifically address kind of this growing chief data officer agenda, we've combined Kin Carta Create's artificial intelligence and data product capabilities with Cascade Data Science's, Cascade Data Labs data science capabilities. And we've launched Kin Carta Data Labs into the market. And this proposition specifically focuses on the Chief Data Officer's transformation agenda. And that's already led to strategic wins with HP, Adobe, Vizio, and the British Heart Foundation. So we look forward to sharing more about Kin Carta Data Labs in the months ahead. I thought it would be also worthwhile to talk through one of Cascade's client stories. So Cascade's global coffeehouse client was on a very deliberate path to become a more data-driven organization. So they hired a new chief analytics officer who was leading that strategy, and they in turn hired Cascade to build a custom data governance solution. And the strategy was to start here because in order for a company to be data-driven, as you might expect, first and foremost, you have to rely on the fact that the data that you're looking at is correct. And CDL designed a custom data governance solution that was bespoke for this very specific organization. It facilitates how data brought into their intelligence platforms. It addresses data lineage so they can quickly determine the source of any data field on any report, and more importantly, detect any anomalies that are captured with any information that shows up on any of these reports, and then alerts the necessary stakeholders of some potential idiosyncrasies with the data that they may be looking at. And this has been an incredibly successful program for them and has led to an expanding set of work for this client. And this governance solution is now a core solution offering for Kin Carta Data Labs. And then on the kind of flip side of that coin, Kin Carta is now bringing new capabilities into this client. So we're excited about this relationship, this new customer, and even more excited about the capabilities of Cascade and our new team in Portland, now operating under the Kin Carta Data Labs proposition. So finally, this increase in demand has led to a significant expansion of our workforce. So since November, we've hired over 100 employees across 3 continents, and we have significantly more open roles to fill globally in order just to meet existing client demand. And what we're finding is our focus on social responsibility, on inclusion, on diversity, and providing folks the opportunity to work with the world's most exciting emerging technologies, we have become a clear destination for some of the world's top digital talent. And alongside of this, we have made it a specific part of our responsibility to scale in a socially responsible manner. So we've undertaken a pay equity review scheme globally for the first time as a firm, and we've reached 98% pay equity across gender and diversity dimensions, and we're on track to achieve 100% by August. And we've also put a massive focus on scaling a cognitively diverse workforce by partnering with several organizations that specifically focus on exposing top talent in underserved demographics and communities. So very proud of our talent acquisition and employee experience teams to be balancing the social responsibility agenda as we scale. So now I'd like to hand it off to my colleague, Chris Kutzer, for a financial review.
Thanks, Jay. I'll start with our half-year financial highlights, which include net revenue of £64.1 million, down 10% year over year due to the pandemic. However, as the graph at the top reflects, we are back to growth, and we've seen quarter over quarter growth since the low point of Q4 over the summer period. Additionally, our 90-day net revenue backlog is 27% larger than pre-pandemic levels. The Create pillar continues to be the primary engine of the company, with 63% of total net revenue. While Create was down 12% to £40 million due to the pandemic, strong demand returned during the period, with double-digit sequential growth in Q2, and momentum is continuing, underpinned by a strong pipeline and backlog entering the second half. Connect pillar net revenue grew 2% to £11 million and comprises 17% of total net revenue. Connect was able to weather the worst of the pandemic storm due to its managed services business and the restructuring that was completed prior to the pandemic. Our non-strategic ventures were down 16% to $11.6 million due to both a pandemic and from closing unprofitable marketing business within Edit as part of the prior year's restructuring. The restructuring and renewed focus has enabled a return to sequential growth and profitability for our ventures businesses. We expect the improving financial performance to continue, and these businesses remain under strategic review. The U.S. now comprises 60% of total net revenue as our revenue mix continues to shift towards the faster growing and larger U.S. market, with the shift accelerated further by the recent ventures divestments and the U.S. acquisitions. In H1, we divested Hive and Pragma for approximately £13 million of consideration, which also included about 100 employees. And we acquired Cascade Data Labs for an initial consideration of £5 million, which is expected to be immediately accretive to earnings. Turning to the next slide, our client relationships and associated revenue are long-term, durable, and relatively predictable, as illustrated here. The graph on the left reflects concentration of client spend and shows our top 30 clients continue to make up over 2/3 of our revenue. The middle chart reflects client longevity, and shows that 75 of our top 100 clients have been with us more than 2 years, and half of our clients have been with us for 4 years or more. The chart on the right reflects revenue predictability and shows that 2/3 of our revenue is derived from clients that have been with us 3 years or more. The longevity of our clients is key to our growth, and it's enabled by both 1, cross-selling Advise, Create, Connect, and 2, leading our clients across different technology journeys that we offer, such as artificial intelligence, cloud modernization, and data science, which all provide clients cutting-edge DX capabilities. In fact, it's becoming harder to attribute revenue between pillars as our clients are increasingly engaging with us across multiple pillars at the same time. Our Data Labs offering is a cross-pillar added value capability that will continue to grow, and as it does, exacerbate this trend, which is further evidence of our connective execution working. Turning to the income statement, the top table reflects continuing operations, which adjusts for the recent disposals. Having already covered the top line, I'll comment on profitability. Adjusted operating profit was £4.1 million, with 6% operating margin and PBT of £2.9 million. The lower margin and associated profit compared to last year were a result of the pandemic and effects of the lockdown on specific clients in H1. We absorbed that impact by keeping some of the affected projects moving with funds from government job-saving programs and working with our clients on longer-term options that are beginning to pay back in fiscal 21. The bottom table provides additional information by removing the effects of the government assistance on the business for both the current half year and the second half of fiscal 20. This provides a better understanding and view of the underlying profitability and trends. Those trends include growth this half year versus H2 of last year, and we are expecting further growth in H2 from here. We utilized the US PPP loans to keep people employed who otherwise would have been terminated. And those employees continued working closely with those clients who previously asked us to slow or stop work. And this discounted work thus turned into longer-term projects and significant client goodwill, which is beginning to pay back now. Adjusting items were $9.3 million and comprised primarily of $6.8 million related to acquisitions and $2.2 million related to the pension, the latter including a further £600,000 related to GMP. Our adjusted effective tax rate was 19%, and we expect this to increase to 21% in fiscal 21 as a higher proportion of group income is derived from the US, which has a higher statutory rate. In response to the fiscal uncertainty caused by the pandemic, we withdrew the dividend last year and will revisit the dividend policy later this year as part of our capital allocation strategy. Turning to cash flow. Our adjusted EBITDA was $8.5 million, and our adjusted operating cash flow was a negative £600,000, including the cash impact of adjusting items, lease payments, and expansion of working capital associated with growth in the late part of H2. The divestments of Hive and Pragma netted cash in of £12.6 million, and that was offset by £5 million of cash spent for the Cascade acquisition. And the net free cash flow for the half was thus £6.5 million. Just to remind you, we halted the pension deficit reduction contributions in agreement from the pension trustees over the summer. But the contributions to the cash expenses of running the scheme continued and are part of adjusting items referenced in the appendix. In September of 2020, we resumed the updated schedule of £1 million of annual fixed contribution in the current year and £2 million of fixed contributions in the next fiscal year. Moving to the balance sheet, let me first highlight the IFRS 16 effects, which were a reduction of IFRS 16 leased assets and related liabilities because we've reduced our leased office needs, terminating 3 leases in the period without penalty. Goodwill and intangibles are £2 million lower versus the year end due to amortization and FX, and down $33 million versus a year ago, due additionally to the impairment of goodwill related to Edit and Pragma in H2 of fiscal 20. Net working capital has increased due to investment in receivables linked to revenue growth since July. The quality of our client base means that we've had virtually no bad debt whatsoever. The legacy DB pension further improved the accounting surplus from 1.1 to 5 million pounds, which is back to pre-pandemic levels. The scheme is well hedged for interest and inflation risks, so we don't expect the significant increase in UK gilt yields or corporate bond yields seen since February of this year to have a material effect on the deficit. We continue to discuss a de-risking plan with the trustees, and the plan was 94% funded on a technical provisions measure as of March of 2019. Cash payments for deferred consideration on prior acquisitions are projected to be approximately 2 million pounds or less over the next 6 months, with the majority of the remaining earnouts for Spire and Cascade payable in Kin Carta shares. The final Spire earnout of 1.6 million in cash and 1.3 million in vested shares will be paid in March. And a further earnout of 1.6 million pounds for Cascade may be made in June of this year, subject to vesting conditions, and up to 75% of this payment may be settled in shares. No further payments are due for either acquisition until September of 2022, when the first earnout for Cascade will be paid. And up to 75% of this figure may be settled in Kin Carta shares. Net debt, excluding finance leases, is now 22.5 million pounds, or 16.9 million excluding partially forgivable US government loans. The 22.5 million is an improvement of 9 million compared to the year end and 43% lower than a year ago. In addition to free cash flow of 6.5 million pounds, we also benefited from 1.8 million of positive translation effects on dollar drawn loans, which hedge our dollar earnings, and 800,000 pounds of US government debt forgiveness. As a reminder, our committed bank facility provides 85 million pounds of committed capacity through November of 2022. Our net debt to adjusted EBITDA is 1.6 times, including PPP loans as debt. However, it is 1.3 times for bank purposes because our banks exclude the US government PPP loan of 5.6 million from their debt calculation. 3.6 million of this is expected to be forgiven in H2, with the balance repayable in May of 2022. So in summary, we've recovered from the worst of the pandemic and we're growing again. And despite the challenging period, we continue to invest in our people and our capabilities, which enabled us to build a material pipeline of opportunity and a record backlog, which we are beginning to deliver. This is demonstrated by the sequential growth we're seeing in our quarterly revenue for both Q1 and Q2 quarter over quarter, and we expect this growth trend to continue into the second half. Our debt levels have improved, our balance sheet is in good shape, and we retain ample headroom on our RCF. This leaves us in very good position to further our strategic goals and our M&A plans. The company is starting to build some real momentum, and I'm very excited about the future. And with that, I'll hand it back to Jay.
Great, thanks, Chris. And next, I'm going to talk a bit about our strategic priorities. So, before our first half, I touched on these key areas of strategic focus that we would have as we progressed over the course of the year, and we made some significant progress across all of them. On the platform enhancement side, we've continued to rationalize our portfolio with the sale of Hive and the launch of Kin Carta Data Labs. And our remaining ventures, Edit and Insight, by the way, are both profitable and growing, and both remain under strategic review. On the partnership front, we've signed over 15 million pounds of new business coming from the partner channel. So this doesn't include existing clients' renewals, but just new business, new customers coming from that partner channel. And to give you a sense, in comparison, our kind of new partner channel last year signed 7.1 million in new business, all of fiscal year 20. So just in the first half, we've doubled what we did all of last year. And this is really driven by the expanding relationships we have with both Microsoft and Google. So very proud of our partnership team's work. On the geographic expansion front, our Cascade acquisition has expanded us into the Pacific Northwest of the US, and we have brought on new Northwest clients, Vizio, HP, Adobe, Adidas, and Starbucks. We're very excited about the market up there and the ability to further penetrate it. And on the global delivery model front, we've increased our Buenos Aires headcount by over 50% in the first half, with further expansion planned in both BA and other nearshore locations by the end of this fiscal year. And I want to flip to the next slide for our social responsibility update. We've made some great progress this half. First, and most notably, both our US and our Argentina businesses achieved B Corp certification. And just as a reminder, B Corp is an external body that audits companies and certifies them as being a socially responsible business. And it's very difficult to get this certification. And the reason we've aligned with it, one, there's a growing ecosystem of B Corp companies, both in the US and in the UK, but it's also a consumer-facing brand. So if you go on the Okada app, for example, you will see a section of that app dedicated to products from B Corp certified companies. So it's a brand that our kin, our talent and prospective talent recognize, and that's important to us. So Europe is on track for certification by August, and our ventures are on track by the end of this calendar year. We also received our first MSCI ESG rating, and we got an A for our rating, which puts us in the top 20% of publicly traded firms in our sector. So this is another governing body in the social responsibility space, and we're happy with that initial score. On the heels of the resurgence of the Black Lives Matter movement, we released our Inclusion, Diversity, Equity, and Awareness, or IDEA strategic plan. And this plan outlines our both midterm and ambitions, as well as our specific commitments for this next year. And I think most importantly, we've open sourced all the research and all the work that we did to come up with this plan, so other potentially smaller consultancies and agencies can take and implement the work that we have done. So very proud of the team's launch of our IDEA strategic plan and the progress we're making on it. And then finally, we also won some new positive impact projects that include partnering with Deloitte on the rollout of the NHS's COVID testing program and winning a significant MarTech implementation RFP with our partners at Microsoft for the British Heart Foundation. And we also won an RFP for a new digital estate for Citizens Advice Scotland. So increasing the portfolio of positive impact projects that we're doing. So work across all these social responsibility pillars are ongoing, but I'm very proud of the fact that we've balanced progress in this area amongst our recovery and continued momentum. This next slide is a quick reminder on the M&A portion of our strategy. So on the right are the 3 types of deals that we're targeting, and the areas in orange font are the regions that we're currently targeting for future acquisitions. And I'll say that our M&A pipeline remains very healthy, and Kin Carta's positioning in the sector, our operating model, and our social responsibility focus has really made it a desirable destination for founder-owned businesses. So we're very optimistic about the deals to come. And then finally, in summary, we're growing. We're a net beneficiary of the pandemic. We worked hard to position ourselves the way that we are, and thankfully got a lot of that hard work done before the pandemic hit. But the pandemic is clearly driving a trend towards digital transformation, and we are taking advantage of that opportunity. The US now makes up 60% of our net revenue and is continuing to increase. And we're continuing to win 7- and 8-figure deals, and our partnership investment is paying off with partner-led new business wins up over 100% versus all of last year. So on the outlook side, strong demand for our services in the digital transformation sector, combined with our successful focus on being a destination for top digital talent, gives Chris and I and the rest of the board confidence of achieving significant growth in the second half and meeting expectations for the full year. Trading at the start of this second half has underpinned these expectations, and market demand for our services continues to increase in all of our regions across all of our pillars, and that's evidenced by both record pipeline and record backlog. So thanks for tuning in, and I'll be happy to turn it over to you for any questions you might have for Chris and I.